Hello, good evening everyone and welcome to our webinar. My name is Becky Bowden and I'm a Regional Sales Manager at London Square. I hope you're all well and staying safe at home wherever possible. COVID-19 has affected us all in different ways, and in this unprecedented time of uncertainty, we wanted to reach out and offer some advice, updates and provide a platform for you to be able to ask any questions you may have in relation to mortgages. To this end, London Square Intelligence is proud to present its very first webinar. Mortgage advice during COVID-19 will be presented to you by the very knowledgeable David Hall of Oriel Finance. But before I hand over to David, for those of you that are new to the webinar scene, you'll find a Q&A button at the bottom of your screen. This will enable you to type any questions you may have. Sarah from London Square and Nathan from Oriel Finance will be on hand to help answer your questions, along with David at the end of the presentation. Please do feel free to engage throughout the presentation and we'll endeavour to answer as many questions as possible. I hope you enjoy the presentation and find it informative. Over to you, David.
Thank you very much, Becky, and thank you to London Square for inviting me to today's presentation. As Becky mentioned, I'm David Hall. I run Oriel Finance. We're an independent whole-of-market brokerage and we cover the full spectrum of mortgages as you would expect. Today's presentation is all about sort of what's been going on in the market over the last couple of weeks and what we expect to see going on in the market moving forward. So the topics for today, we're really going to be looking at mortgage repayment holidays, mortgages in process, mortgages that have already offered, how they might be impacted, pricing and product availability, help to buy specifically, loan to value and the restrictions that have been reported in the press, lending at the moment and then lending in the future, sort of the post COVID-19, and then open to Q&A at the end. As Becky said, one of my top brokers, Nathan Bakbaki, is actually on this call and will be available throughout the process to ask any questions that you have. Please use that Q&A button, and any questions unanswered at the end, I will look to go through live if possible. So if you have a mortgage already, what is the situation? What is a mortgage repayment holiday? Well, the best way to look at a repayment holiday is a deferral of your mortgage payment. All it means is that you will be adding that payment that you're not making onto the capital outstanding on your mortgage, and you will be paying it in the future once you sell the property or when you come to remortgage. It means that your future payments will be marginally larger than your current payments because of that additional loan size. Basic maths for you: if you have a £100,000 mortgage at the moment and you have a 3% interest rate, if you are just servicing the interest, that's a £250 a month payment. If you defer 1 month's interest, you will now owe £100,250, and your new mortgage payment after 1 month deferral will be up by 63p per month. It's important to note that this is compound interest. So if there is a situation where you defer more than 1 month's payment, 2 months or 3 months, it won't be 63p every month that's added on. It will be slightly more because you'll be adding on to that debt. Eligibility for all those mortgage deferrals, well, basically it doesn't matter what type of borrower you are, whether you're a first-time buyer, whether you're a landlord, whether you're an international landlord, whether it's help to buy, whether it's shared ownership. The government has said that anybody who needs it will be eligible. It's all about understanding what your financial position is and making sure that you've looked at the best way to deal with those payments. How to apply? We always say, as a mortgage broker, you'd expect it. Speak to a broker in the first instance. Make sure that the decision to take a payment holiday is actually the right one. Understand all the implications that there may be for taking that payment holiday now and in the future. Should you be looking to make that payment though, the best thing to do is speak to the bank directly. A lot of the banks at the moment are taking huge volumes of calls, so we'd recommend in the first instance that you make your application for a payment holiday online. Most of the lenders have very specific websites and have a very clear path to getting these payment holidays agreed, and it's much quicker. Some of the call times and the waiting times for getting through to somebody on the other side can be in excess of 4 hours. All brokers in the market, whether you've used them before, whether it be Oriel Finance or anybody else, will be very happy to talk you through the process. So please use the intermediary environment and the experts that are in the market to make sure that that is the right decision for you. Mortgages that have already been offered or mortgages that are in process are slightly different. We've been having many calls over the last couple of weeks, which are summed up in this statement. Practical completion has been delayed, a mortgage is offered, but it's due to expire. Again, the government is set out to protect people in this position, and the banks are acting on your side. They're taking a reactive rather than proactive approach though. So what they'll look to do is renew your mortgage and extend the offer validity by between 1 and 3 months. And that is no questions asked. But that is only if you approach your broker or approach your bank before expiry. So again, what we're saying is be proactive here. If you think your mortgage offer is going to expire before you can actually complete on your purchase, whether it be new build or an all stock property, make the call beforehand. You will be happy and surprised with the outcome, we assure you. Pricing and products. At the moment, the market pricing hasn't reflected the interest rate reductions that the Bank of England's come out with, and that's because there's a bit of a dislocation between resource and availability. So if we look at this, there are 5 key areas that the lenders have to think about when they're pricing products, and that's human resources, market liquidity, market factors, operational factors, and then loan to values in terms of risk. What we're finding is that the lenders have only got a finite amount of human resource. And what we mean there is they have a certain staff count. It's not possible for them to just recruit overnight thousands of extra staff. And in the market that we're in at the moment, they've had to defer the staff they have from the new business sectors into their existing loan book sector. So they're looking at helping out the people that have mortgages and that might be feeling financial pain. And that's meant there are less people in the front end to deal with new inquiries. The easiest way for the bank to deal with that flow of business coming into them is to make themselves less competitive or to make themselves available to a smaller sector of the market. And that is why they're reducing these loan to values. So it's not them being worried about the property market per se or values. It's actually that they're trying to manage the deal flow that they can deal with. If we look at Help to Buy specifically, it's probably one of the least affected parts of the market at the moment. Where we've seen some of the banks reducing loan to values, London Help to Buy, for example, has been completely unaffected. When you have a 40% loan from the government plus your 5%, you're at what we would call 55% loan to value or 45% deposit, and all the lender restrictions sit above that threshold. When we look at regional Help to Buy, where the government is providing a 20% loan and the client is paying an additional 5%, the majority of the market is unimpacted. And some of the lenders in this space have doubled down and they are absolutely still lending. I think a hero in this sector at the moment is somebody like Nationwide, who are actively looking to provide solutions for that national Help to Buy market. Lender restrictions really come back to that loan to value and then really assessing how they look at risk. And what we find, certainly in the Help to Buy space, but across sector, is a naivety of clients in understanding how a bank assesses risk. One of the key areas that banks are looking at the moment when they're building their internal profiling and their internal ratings for applicants is on where a client has said they lived and any historical addresses. Time and time again, we're seeing clients missing out the address that actually holds the highest credit impact on their application. So when you're looking to buy your first property, even if you haven't lived in a parental home or your family home in the last 3 years, make sure that you let the bank know what that address is, or you let your broker know what that address is, because they will make sure that it's keyed. It usually carries a significantly higher credit rating than the current address you're in, because you may not have changed your electoral roll address, and you may not have changed your bank statements and any other registered details. Loan to value restrictions, again, just reiterating what I've said previously, is it's temporary, and that is the thing to take. It's resource-led. The lenders at the moment do not have enough people employed to be able to go and look at the front end when they're dealing with sort of the back end issues that they've encountered. It's not out of market uncertainty or an unwillingness to lend. It's just a resource issue. Investment lending, just to touch on that for a moment, the buy-to-let market has certainly been impacted, but is less impacted than the normal residential space. And that's because the investment market sits at a lower loan to value overall at a starting point. So most buy-to-let lending, led by PRA guidance and the FTA, sits at between 25% and 35% minimum deposit, and that sits comfortably where the banks have reduced but their loan to values. Where there have been temporary reductions from some of the bigger lenders in the market, we've seen some of the smaller niche lenders enter. So where the likes of Halifax have come out and said they will reduce some of their lending across the book, we've actually seen some of the smaller lenders come in and absorb that space. Those lenders aren't necessarily the types of lenders that you'd see in the Sunday Times Best Buy list, but they are just as competitive. In many instances, they can be more competitive. They just don't have the volume to take mainstream lending as quickly. The government's also said that there will be no mortgage prisoners during this period, and the banks are taking that very seriously. Where there's a situation where you bought a property already and your loan to value was what's considered to be high in this market, so if you bought a 10% deposit or 15% deposit or even higher than that, the banks may not be looking at giving you a normal remortgage rate. But because of this mandate from the government, there are assurances that have come through from banks saying that they will look to offer clients remortgage options that are competitive and in line with their current lending rates. And that means that you can have a conversation with your existing bank or with a mortgage broker to make sure that you don't go onto the lender's standard variable rate, which in this market may be relatively penal. Lending in a sort of now and in a post-COVID-19 era really comes down to a couple of pieces of key information. Competitive solutions are driven by accessing alternative, niche and smaller lenders. And I touched on that. It's the lenders that are in the market that aren't shouting and dancing and appearing in sort of the mainstream press with those best rates. They're the ones that have a lower profile and a lower capacity, but an absolute willingness to lend. And talking to a mortgage broker will give you that opportunity. And in fact, just scouring online will give you access to things that you didn't know were available. We haven't looked at valuations as being an issue in this current market, but absolutely it has created a significant pinch point in the market where there are lending solutions at the moment. Because of the inability for surveyors to travel and actually go to properties, there is a short-term issue in actually carrying out valuations. What we've seen in the market and what we will see moving forward is the rapid evolution of the automated and desktop valuations. And what that means is that where there is enough historical data and enough information surrounding a property, especially in the new build market, the surveyors will be able to get comfortable to provide a valuation remotely rather than accessing the property. So even if they haven't been, they will be able to give a valuation to allow completion to occur in a timely manner so that you can move in. Capacity to transact, again, is just looking on our side of the business, who in the market actually has the staff in the right departments and are actually processing things in relevant timescales. At the moment, we have some banks that are operating normal procedure as normal. We can put a mortgage application in on a Monday, it can be agreed within 48 hours. We can be in a situation where it goes to an automated valuation before the end of the week and have a mortgage offer out within 5 working days. There are other banks that are looking at an 8-week processing time. So it's important that we explain to you as clients and the market explains that these are actually short-term issues, just where the resources are stopping clients from being able to, or the banks from being able to transact normally. Finally, it's understanding lenders' exposure to different borrower subsectors, and that is going to be key moving forward. The lenders are going to be actively managing and trying to balance their mortgage books. No one bank wants to have all one type of applicant, and it's understanding that sort of at a higher level and from a macro point of view, where some banks are taking on lots of first-time buyer or help to buy business 1 month, they'll then not want to take that on the next month. Sometimes they'll be taking on a lower loan to value or an older type of profile client, but they'll want to take on some lower risk or higher risk clients in a different sector. We'll get that information and we can manage that flow so that we can make sure that anytime there is an application that goes in, it's got the highest chance of actually being agreed and proceeding to a mortgage offer. So that's really where we're seeing the market as it stands today. That sort of goes through the summary of sort of what we wanted to get out there and give you sort of an idea of the market. Yeah, there are solutions that are available, and it's all about just being adaptive and proactive rather than sitting back and letting things happen. There have been a couple of questions whilst I've been talking, so I'm just going to have a quick check of that. But if you have any other questions, again, please do go to the Q&A button on your screens and we'll have a look. I'm just having a quick look through these now. There's a message from Sandra. The question was, will the bank question how secure my job situation is when trying to get a mortgage offer at the moment? No, they're not going to ask you directly how secure your job is, but if there are any changes in your financial circumstances, you are under an obligation, and we as mortgage brokers are under an obligation to notify the lender. Transparency is always key in any type of transaction, whether it be in a mortgage application or any financial transaction or in life in general. So if you let the bank know and you let us as brokers know what the situation is, we can deal with that. It's much better to be honest and go through the process than to be deceptive and then get found out. Because if there's an issue with it and it's been shown that you've been less than truthful in a situation, it will have a hugely detrimental impact on a mortgage application. What I would say is that a lot of the banks at the moment have gone on record and said that if you were, say, furloughed or operating under reduced hours, they will still consider your mortgage application favourably. It's on a case-by-case basis, and it's all about understanding what that situation is. They are not naive to what's going on in the market. They are being very, very reasonable. And if you take nothing else from today's presentation, please understand that the banks are being reasonable with regards to changes in people's circumstances. Just a question from somebody anonymous says, can you apply for a new mortgage right now, and if so, with who? Yes, is the answer to that. There are over 5,000 mortgages available in the market as we speak today. So there are solutions available to nearly anybody. Who it would be with is obviously dependent on the situation of you as individuals, as borrowers, and it's about understanding that situation and then putting an idea of what criteria we can use to get that mortgage put in place. Emily, there's a question through that came in and said, are you able to lend to your income has been furloughed? Yeah, again, just sort of going back to the question answered by from Sandra. Yes, it's an individually assessed situation, but the banks are being very positive about it. We have to understand it. Under FCA guidelines, a loan has to be affordable at the point of inception. So if there's a reduced income from furlough, it has to be considered, and the bank has to have done significant due diligence to make sure that if it does look like it's temporarily outside of normal criteria, they've done everything they can to bring that loan into a sensible conclusion. Have a look at some more. Just a sort of a message in from Colin just saying, do I think there'll be a big effect on house prices post COVID-19? I'll probably regret answering this. Why not go there? It's very difficult to say, but the fundamentals of the market pre-COVID-19 and post-COVID-19 shouldn't be dramatically different. I think it would be very naive to think that there will be no impact on prices, but there's also a lot of pent-up demand and a pent-up supply of lending that has to be got out there. So where people think there'll be dramatic changes, I'm not quite so sure. There may be a temporary short-term drop, but I suspect that based on the way that loans are at the moment, there won't be many transactions in that period as we're seeing at the moment, and therefore the market will recover very, very quickly. But we shall see whether I'm right or wrong there. I might be being naive to that situation. On interest rates post COVID-19, and just to pick up on that, I would say I suspect that we'll see some interest rate drops coming through as the lockdown subsides. Really, that's because if you look at the short and medium term lending market at the moment, it hasn't reflected the base rate drop. So if we take the actual pricing of debt out of the equation and look at the fundamentals that sit within the financial markets, the Bank of England base rate dropped from 0.75 to 0.1%, and people sort of sitting outside of the market assume that means that mortgage rates would drop by the same amount, by that 0.6% or 60 basis points as we refer to it. The reality, though, is that there is a whole plethora of opinions as to how long people think that the base rate will remain at that 0.1%. And that means that the medium-term money, so the market where you're looking at, say, 3 years, 5 years, 10 years, actually doesn't reflect anywhere near as much as a 0.6% drop. Once we've got out of this lockdown situation and the market gets an understanding as to what that looks like, of which I will confess I have no better idea than anyone else. But once that's happened, we should see a situation where that economic stability, or post-COVID-19 economic stability, gives people an idea of what the market looks like in the future, and you'll probably see a little bit of market compression because of competitiveness over that medium-term pricing. Just a question that came in just now, and we've got to think about timing. Sorry about this, but one of the questions came in is that is it possible to remortgage or product transfer onto a rate with no early redemption fees? Short answer, yes. Longer answer is it really depends on who your mortgage is with at the moment, and that's where talking to Oriel Finance as a broker is probably the most valuable call you'll make at the moment. There are situations where some banks will offer product transfers, but with lengthy tie-ins. So they're keeping you locked in for an extended period. But what we're looking for a lot of people at the moment is they were looking to move, looking to exit the mortgage that they had, and are now stuck in a situation where it's going to take a bit longer. So in that situation, what we can do is either do a product transfer onto a special rate that has no early repayment charges, or we can look to mitigate or minimize the early repayment charge. So really it's a conversation to have with one of the brokers, and please do pick up the phone after this webinar, and we will see what we can do to help out. Actually, just on that, I'll think that should, oh no. Oh. Sorry, just so that everybody's got it. These are my contact details. Please feel free to email me directly with any questions that you don't think have been answered, or with any inquiries. We will be very, very happy to help. I've got a team of people that will happily give advice out with no charge and no obligation for you to move forward. Just to see if there's any other questions I can answer right now. One of the questions just surrounding valuations that just came in, just looking at whether valuations pre-coronavirus are too high given the economic impact of the virus. Well, it's very difficult to call that, and I think that it would be outside of the scope of a mortgage broker to really give you a definitive answer. I don't want to sort of duck out of that question, but what we've seen so far, and from the cold face of people doing loans at the moment, is that where quality product has been delivered to the market, we haven't seen slips really in valuations. If we look at the applications that went in for Oriel Finance last week, which total about 15, I think we had 15 applications last week in this environment, and looking at 3 weeks ago for products that were submitted and then the valuations that occurred roughly last week, we haven't seen any down valuations from the clients that we've done applications for. So at the moment, we would say the property values have remained relatively static, but that is probably due to a lack of information. It's too early to tell, I would say. Just a question that came in. I'll just answer this one last question, and I think I'll hand back to Becky to finish off, and as I say, very happy to continue answering questions, so please email me, post this, or do give me a call. There's one question here that's just saying, what about existing loans with them? Are they flexible with deferred payments? And again, just going back to almost the first slide, the government has made it very clear to banks that they are to be flexible about deferring these payments, and payment holidays are available to any type of borrower if the situation warrants it. The only caveat I would have is that these are not necessarily they are not necessarily payment holidays that you'd want to make unless you needed to. If you have an ability to service your loan, it's much better to continue servicing it, because otherwise you will be paying additional interest over the life of the loan. And even though in my example it was 26 pence a month, over the period and lifetime of the loan, that adds up to a not insignificant amount of money. And if you're borrowing significantly more money than that in the first place, and your interest rates are higher, and you make more than one deferral on your payments, it really will make a difference. So the recommendation from, I think, any financial advisor, any mortgage broker would always be, if you can make the payment and you can make it without putting yourself into any financial difficulty, then that's what you should do. Thank you very much, everybody, for your time today. As I say, I'm just going to hand it back to Becky to just close off. And if you have any questions, please do feel free to reach out. Thank you.
Thank you, David. That was a great update, and I hope that everyone tuning in also found it informative, and I do hope that it's provided some of you with some confidence and reassurance to move forward in the property market. If we didn't get an opportunity to answer your question, or equally you didn't get the opportunity to ask a question, or have since thought of one, then like David said, please do get in touch via email or telephone and give him a call, and he'll be happy to assist you there along with his team. Equally, London Square are on hand to assist in any way they can as well. And whilst our sales suites are currently closed, we are all still working, and we are able to carry out virtual viewings and take reservations. So please do visit our website, www.londonsquare.co.uk, for further information on how to get in touch. Thanks for joining us. This is our first webinar of what we hope to be a few more. So we'll be in touch with any further webinars that we feel may be of interest to you. Thanks for tuning in, and we do hope everyone stays safe and stays well. Take care now. Thank you.